Okay, let's get started. In Canada, housing is very popular and a very hot topic. And understandably, it's a big topic for the media. Um, we'll take 1 to 2 minutes just to let everybody get signed in and settled in, as usual with our webinars. So here's a quick outline of, sort of the typical housekeeping items that we have. The presentation itself will be about 30 to 35 minutes long. And then we'll have about 5 to 10 minutes for questions from you, the audience. We are recording this session, and we will share the recording and the presentation deck with you afterwards. We've placed you on mute for the webinar, but you can ask questions to the speaker via the chat feature, and you can use that same chat feature if you're having any technical difficulties and someone can help you. Okay, let's get started. In Canada, housing is a very popular and a very hot topic. And understandably, it's a big topic for the media. Many times it's sensationalized and it's often focused on the top line. We've all seen the recent headlines, everything from prices fall by record amounts and will fall much further. There's a housing crash, there's a bubble. There's a whole bunch of similar variations on the theme, and I'm sure you can think of quite a few. Now, we're not saying that this is all the media or all the time. We do have a lot of respect for the media and the profession. And really, it's something we all do, or many of us do, is speak to the top line and really do some quick summaries. But it does have implications, and I think it does create, in some instances, problems. Whether that's questioning yourself, if you've been in the market for a long time and know that the housing fundamentals are sound, which is maybe not a bad thing, but getting a lot more questions from your customers and getting a lot more questions from executives, investors, regulators, and other stakeholders. So just going by the top level, it doesn't really give you the real picture. It's much more nuanced, and we do believe here at RPS that it's not as bad as it's made out to be or may seem to be. But we'll show you the numbers and you be the judge. So as you know, we at RPS have a lot of data and analytics on the housing market and house prices. And that's in addition to a whole lot of experts and long-standing experience in real estate valuations. Our presenter today is one of those experts. Rob Maughan is a Senior Vice President of Technology and Solutions Delivery at RPS. He also heads up our data and analytics team, which is the team focused on the creation and implementation of our data and analytics and technology solutions. His experience is extensive. It includes work in financial services, real property data, risk management, and technology fields in both Canada and the US. He brings, I believe, a ton of knowledge and insights to any discussion on the housing market and house prices. So now I'll pass it over to Rob Maughan for his presentation. Enjoy.
Thanks very much, Yvonne. Wow, that's quite an intro. Hopefully we live up to that today. So sure, let's get into some market insights and see what's happening in the Canadian real estate world. So if we go to the next slide, it is true. The general trends, the media is not wrong. This is the way the world looks. And so this chart is a depiction of what our house price index is showing since early 2020. So on the left axis, we can see the actual index value, and we've got a bunch of lines on here which represent aggregated property styles at the national level across various large markets. And we've also plotted here the bank prime rate, which is for the right axis. And so we can see over the first 24 months of the pandemic, absolutely, house prices went up. They went up faster than we'd seen historically. And more recently, since basically the spring of 2022, they've started to come back down. Now, one of the things we have to understand is that when you look at these top line numbers, they don't tell you everything maybe you need to understand about individual discrete markets. And so if we move along to the next one, we see one of my favorite charts, actually, and not just because it has all kinds of squiggly lines, but part of our house price index measures the year-over-year percentage increase or decrease at the neighborhood level. And our neighborhoods are defined as forward sortation areas. The FSA, for those of you who understand, it is the first three characters of your postal code. And inside our house price index, I think we manage around 1,500 of them. And so we get a very, very detailed understanding of what's going on in very, very low-level geographies, local markets. So here again, what we're seeing is the dotted red line is the bank prime rate. And what this is showing us is the year-over-year price appreciation or depreciation and the balance between how many neighborhoods are going up or down month over month. So this starts back in 2006 January. It goes all the way to December of 2022. And you can see that, for the most part, starting around 2010, over to when the start of the pandemic, things were fairly much in balance. 60% of markets were seeing month over month increases. 40% we're seeing decreases, and we've plotted this as aggregate properties, so all property styles. We have the single family detached growth and decline, and the condo growth and decline. But as we sort of focus in on the start of the pandemic, we see that the interest rates certainly did dive. They went down quite significantly at the start of the pandemic, and that triggered this change at the neighborhood level to where, we see maximums of around 95% of neighborhoods across the country. We're seeing year-over-year gains on a monthly basis. And on the flip side, of course, it's about 5% of the neighborhoods are seeing a month-over-month decline. If we then move towards the spring of 2022 and, where we see the interest rates increasing, the Bank of Canada trying to control inflation and things like that, all of a sudden we see dives, things coming back more into balance. So the number of neighborhoods showing increases has dropped significantly. The number of neighborhoods showing decreases has jumped significantly. And so what does that mean? Well, part of the problem with markets as volatile as this is it's very difficult for folks like us, appraisal management companies, folks who produce automated valuation models, and even the appraisers out there in the field. It's very hard for them to keep up with this kind of volatility, but we do our best. And, what do we see as sort of the trend here? Well, last week on the 25th, the Bank of Canada raised the rate again, a quarter point. And I really do believe that, the calipers, as I like to call them, they are probably going to see a bit of inflection. We are probably going to see more neighborhoods in decline month over month than we do see neighborhoods that are in growth mode. But I don't think it's going to be as bad as it was after, say, the 2008-2009 subprime mortgage crisis. I don't think we are going to cross the point of balance to that degree. Over the coming year, I think things will settle down. I hope the Bank of Canada keeps the rates where they are. I'm a variable rate customer, so that's in my best interest. And I think, the market dynamics, supply, demand, all these things that we hear about, hopefully things do return to a bit of a state of normal, and we don't see, this idea of a crash or a full-blown recession sort of thing. Now, speaking of volatility, and this is just a little bit of explanation about how house prices try and do their job, house price indices. We noticed over the last year, our clients noticed and gave us some good feedback that our house price index wasn't exactly maybe as sensitive to all the dynamics that were going on in the marketplace. We undertook an exercise, took us about 4 or 5 months, get our data scientists working night and day, trying to figure out how do we enhance the sensitivity of the index. And we use a machine learning model, which has as sort of part of the post-processing, it uses a smoothing algorithm. It's called a Kalman smoother and filter. And so what we did was we introduced the bank prime rate as a feature into the model to try and boost the sensitivity. So if you look at the top left chart, you'll see the old model, and the squiggly blue lines are actual observations of house price transactions. And where we see a big jump right there in the middle, you'll see the orange line is the model trying to keep pace with that change. By introducing the interest rate feature, you can see on the top right that what we've managed to do is as soon as the market shifts, The algorithm, the smoothing algorithm, what's known as the Kalman gain, the ratio of estimations to actual observations, it's very much better able to keep pace with where things are going. The ideal state for our house price index is where that orange line floats in the middle of all those observations. That is what we determine as the normal best result. So the bottom chart there is just showing you the difference between the two models. The dashed lines are the old way. The solid lines are the new method. We plotted again the bank rate on there for you so you can see how when times of great change happen, the model is much better able to keep pace with what's going on out there in the world. And I guess as a small plug, it's now commercially available. So we've got it tested, and retested, and ready for prime time. So let's get back to digging under the hood a little bit and start to see what's maybe going on in the world and how to sort of look at things. So if we look at the next slide, this is trying to demonstrate that not all markets are created equal. So what we've done here is we've plotted price appreciation on the y-axis in percentage, and we've looked at a bunch of major population centers in Quebec and Eastern Canada and across the country. And what this is trying to show is that it all depends on when somebody purchases a home. So if we take a look at Halifax, for example, the dark blue line on the right is an example of if Rob purchased a house in Halifax, single family detached, in December of 2017. If I compare the value of that home to December of 2022, I've done really rather well. I now see an 80% increase in the value of that home. So again, if Rob was clever and he managed to purchase a house in Halifax in, say, December of 2019, I would be realizing a 70% gain on my investment. Now, if I poorly timed the market and I bought, let's say, in December of 2021, just before the spring highs, in Halifax, I'm still seeing a 10% improvement in the value of my house. And so as we look at Quebec and Eastern Canada, we can see that most markets are behaving really okay, Longueuil being the exception in Quebec. And you know, this is a function of the fact that, you know, affordability metrics out east really do speak to first-time home buyers, folks who are thinking of relocating from other parts of the country to do remote work, and sort of a better balance of supply and demand of actual properties for sale. We now switch to look at Ontario. It's not quite as rosy a picture. So pretty much every market, major market across Ontario, Toronto, Mississauga, Brampton, you know, London, Vaughan, Kitchener, they're all seeing that if you had purchased a house December 2021, you've actually lost a bit of money. Your value has eroded. Ottawa, Windsor, bit of the exception to this rule. Windsor did get so high, and I think it's still a function of affordability metrics. And we know Ottawa is a slightly different job market than the rest of the province. But the GTA regions are definitely under pressure. Again, housing supply, the impacts of inflation on affordability, first-time home buyers, you know, there really is nowhere to get into the Toronto marketplace or the GTA marketplace if you had been budgeting, you know, using numbers from a couple of years ago. Things aren't looking as good. Now, it's not all doom and gloom. If we move out west, we can see that pretty much all the major markets out there are doing really rather well. Abbotsford, BC, obviously a bit of an exception here. But if you're looking at Calgary, Edmonton, Red Deer, Saskatoon, you know, you're still doing okay. If you were, you know, really trying to time the market. But again, this goes down to affordability metrics, interprovincial migration, you know, Calgary, Alberta's job market, solid, and the affordability out there is certainly better than it is in most cases in Toronto or in Ontario. So that's just another way to sort of understand, you know, how the markets are moving and that not all markets are created equal.
And also the context that the increases were so significant and not historically usual that, you know, small decreases currently are not that bad of a thing when you put into the context of the full time period.
Absolutely. Absolutely. So now, pardon me, but I can't remember what's on the next slide. So if Laura could flip over. Oh, there we go. I can't memorize everything. Right. So, and then, there's this notion we hear a lot about in the media. And again, it's not necessarily the wrong way to look at things. But it is the average price has dropped in this particular part of the world, or average prices are going way down. But again, you have to get under the covers here and you have to understand what is going on to make average prices go down. So in this chart, on the y-axis, we see the percentage of annual total sales. So how do I explain this so it kind of sort of makes sense? Along the bottom are price tiers, price buckets. So if you look at the $500,000 price bucket, that's just an indication of houses that sell between $400,000 and $500,000. And so what we did here was look at the Q4 of 2021 and the percentage of home sales that are happening in those buckets as a percentage of the year's total. So if we think about, the $500,000 price tier, and in a year there were 1,000 sales in that price tier. In Q4, if there were 160 sales, that would be 16% of the volume in Q4 was in that bucket. So what we see is that if we compare Q4 of 2021 percentage of total to Q4 of 2022 percentage of total, the market has shifted. The blue line indicates that far more transactions are happening in the lower price tiers than they were the year before. And likewise, stealing from Peter to pay Paul, the amount of transactions that are happening in the higher price tiers has significantly dropped. So this is what we have to think about when people talk about the average sale value of a home in Toronto. Is it a function of all values going down, or is it a function of where the transactions are happening in various price tiers? So this is showing you the all property types. If we go to the next slide, we get a view of single family detached. And again, we see the same, things happening. Now, I would truly like to know where there are houses in Toronto that sell between $200,000 and $300,000. But this is what the data shows us. But again, you can see this change to the lower value brackets, quarter Q4 21 to Q4 2022. And again, and if we go to the next one, we can see what's happening in the condo apartments. Not quite as dramatic, but definitely a shift, right? You are seeing fewer transactions in the higher dollar brackets. That transaction volume has gone to the lower value side. So
Yeah.
we have to think about what is happening in the market to drive average values down.
And it really shows the impact of affordability, and also people who, might have incurred increases in their homes and don't want to sell and don't have to sell. So two sort of ends of the market really exhibited here.
Yeah. And one last point too, Yvonne, is that, the volume transaction has significantly gone down between those two periods as well. So those are people sitting on the sideline, people maybe don't, I'm not going to sell my house for less. So they're just taking a pause. And we know, the investor community has certainly stepped to the sideline as the interest rates have gone up, because it's not been quite as profitable for them to get in the market right now. So interesting dynamics for sure. Now, what comes next? Oh, here we go. Right. So where should I be worried, Rob? Well, not everywhere. I think really that is the message. And so what the house price index data is showing us is that, there certainly have been value declines since the spring highs of 2022, but it isn't happening equally everywhere, right? And so we really do have to dig, and not just down to the city level as we're seeing here. So, we see neighborhoods like Calgary cities like Calgary are down, a little bit, relatively speaking, from the spring highs of 2022 to December of 2022. But areas like Delta, BC, Toronto, these are all places that we've heard about. But interestingly, places like Orangeville, Ontario, seeing a big drop in prices since the spring highs. And if we take a look nationally, so at our city level indices, the urban city level indices across the country, 80% of them are down since the spring highs. 76% are down in the condo apartments. 78% of rural city level indices for single family detached, those are down as well. But if we look at it provincially and we do some simple averages, we see that, urban cities in BC down 11%, urban cities Ontario down 16%, but Alberta, Quebec, again, modest declines, -5, -3% respectively. So this phenomenon is not going on equally everywhere. And then if we take it to the next level of granularity, and we start looking at those neighborhoods, yes, this is a rather dire view of some pretty stressed neighborhoods across Ontario for single family detached homes. And certainly Moore Park and Clarington and Windsor City Centre, Markland Wood, yes, okay, they are down significantly. Now, interestingly enough, I was talking to somebody yesterday and they said, oh my goodness, I should be buying real estate in Moore Park. Well, good luck to you, because I checked this morning and there is a single listing in the Moore Park neighborhood right now. And I don't have $7.5 million, so I won't be a taker. But if we do take a look at something like Burnham Thorpe, which is a neighborhood on the border between Mississauga and Toronto, just north of the QEW, we see that it definitely has dropped since the spring highs of about 26%. But its neighborhood, a place called Lakeview, which is on the south side of the highway, going down to Lake Ontario, it's actually seen its single family home prices increase over the same time period, 8%. So this is not a phenomenon that is affecting every single area equally. And so, I think of lenders, insurers, folks like that. Certainly, yes. If you had done a deal in Burnham Thorpe back in the spring, could you have your LTV now over 100%? Is that a good thing? Absolutely not. But it's a matter of understanding where those concerns are happening. And, are you in balance? Do you have an equal distribution of risk of that problem? Is it isolated in a particular part of the world? Overall, are you doing okay? So, getting down to these levels of geography really, really gets you some of the most detailed insights to understand how the markets are working, how your business is performing. And I think if we move now, we're going to talk a little bit about homeowners. Clever bunch, to be sure. But because of our position as an appraisal management company, we do a lot of valuations, for purchases and refinance transactions. So refinances are interesting for us because that's where the property is not listed. There aren't two people, sane, rational individuals deciding on the value of a home, shaking hands and exchanging keys. These are things where the house is not on the market. So when we think about the information a homeowner gives to a lender, I need to refinance my mortgage. I believe my house is worth $500,000. What sort of a mortgage deal can we come to? So that consumer, that homeowner's estimated market value is what they believe it's worth. Appraiser goes out and does a full interior inspection and comes back and says, well, you thought it was worth $500,000, but actually it's worth $550,000. And so when we look at the ratio of how well a homeowner understands the value of their home to what it's actually worth, starting in Q3 of 2021, if we take a look at somewhere like Barrie, for example, for the first number of quarters that we're tracking here, the homeowners are undervaluing their house. Now, it's not significant, 5%, on $1 million house, because I have to do easy math, that's $50,000. So they're not totally out of line with what they think their properties are worth. But it's interesting, as again, we get to these spring 2022 highs, we track the interest rate increases, and then we see the values start to tumble. It's interesting how the homeowners, there is this lag of what they understand the markets are doing. And, if we go look at some other parts of the world, I believe the next one will show us areas across the country. we can see that consumers, the previous slide we saw, most consumers were guessing low and then they started guessing high. But it's interesting how in Regina, everybody always believes their home is worth more than it probably is. And in Montreal, they're very conservative. So again, it's understanding how the consumers are perceiving what the markets are doing. And so for a lender, for example, I think there's an opportunity if you're using sort of market information like a house price index for you to be able to better set the expectations of that borrower, right? Nobody wants to have a conversation where, certainly it's easy to say your house is worth more. But if they do come in and they say, well, I think my house is worth $1 million, and you actually have the data to show them that, well, actually, maybe it's only worth about 925, that's an important conversation to have with those borrowers because it sets the right tone for the rest of the transaction. And I think, hopefully, you've got some reasonable, interesting, warming, because goodness knows it's cold out there today, insights into housing markets.
Thanks, Rob. And before we get into the Q&A, I'll elaborate a little bit more on that last point that you were making. Part of it is too, when house prices are increasing really fast, it's hard. We've seen it, even people who are in the industry to keep track of how those prices are changing, especially at that neighborhood level. And then once prices start to come down, it's also hard for people to believe that the value of their home has gone down. And a lot of people will stick to the price that they saw last spring as they're thinking of what their home's value is. And, the other part is really, a lot of consumers are challenged in estimating the value because there is, in many instances, very limited data sources available, either at that local neighborhood level or specifically to their property. And we've seen research by the Bank of Canada. There's an excellent paper that they've done on the formation of house price expectations and our own experience and research at RPS that shows that consumers significantly revise their expectations to be more in line with the actual market value when they're provided with that relevant information at that market, at that neighborhood and property style level. And, we've worked here, we really are passionate and do believe that it's important to help lenders, mortgage professionals, consumers in that home journey and really make it better. So that's a lot of the time that we've invested in the house price index and our house price tracker and a variety of other different solutions that we have. So I'll leave it at that, but we'll move into questions. So if anybody has questions, please type them into the chat. But I'll start with, for people who have attended some of our events, they know this question that we normally ask the economists, and poor Rob is going to get the question now, which is, and I'll increase the number a little bit, but if you had $5 million to invest in residential real estate in Canada, where would it be? What would you invest in?
Well, if you're going to make me invest in residential real estate, Yvonne, as opposed to maybe a nice safe GIC, I guess I would go back to the fundamentals. I think it's truly, the three rules of real estate: location, location, location. I think I would prefer, areas that have sound quality of life components, proper access to services like hospitals and education, good transit. But I think I'd focus on parts of the world, parts of Canada where, it's that sweet spot of sort of what appeals to a first-time home buyer. I think if I was doing this as a real estate investor, I'd be looking for, townhouses, nice, cute little bungalows, potentially condo apartments, but in the bandwidth of, if this does turn out badly, is my asset very marketable? So am I going to pick neighborhoods? I don't know. I mean, and it's odd because my wife and I, we have a 5-bedroom home with no kids living in it anymore. And we have this conversation all the time. If we were to sell our house, it's not worth $5 million. Would we move into downtown Toronto into a condo, which is super great for access to all the things that Toronto offers? Or would we go to Belleville, which, is a 2.5-hour drive outside of Toronto on Lake Ontario, that has some very nice neighborhoods. And the conversation we have is, if we sold our house, we wouldn't put any money in our jeans if we did this condo idea in Toronto, but moving to somewhere like Belleville, could we net ourselves a little bit of cash that we could tuck away for retirement? It's thanks for asking me the hard question first.
Yeah, supply demand and where the opportunities might be. The question that I do have as well, I know that you and your team did a lot of research around the impact of interest rates on house prices and how there is impact on some markets. Curious about any sort of other interesting findings that you had. There's some markets, could you see what happened in terms of the ones that were the most impacted, the ones that weren't? Any sort of insights that you can share with the group, the audience?
Sure. I think there were 2 or 3 things that actually stood out. One was this the lag, right? So the interest rates, they came down really quickly back in the spring of 2020, and they went up rather quickly last year. And what was interesting to note was the sort of the reaction time of the markets. And there was a slight difference in the lag of how the markets reacted when they seem to react faster when rates go up than rather when rates go down. Do I have a fulsome explanation for that? No, not really, but it was an interesting thing to note. And the other thing was, to this point of not all markets react the same. We did poke around trying to do some sort of macroeconomic understanding of, well, why is this neighborhood doesn't really care about interest rates? Is it because it's a resource economy? Is it because it's an urban center versus a suburban center and things like that? Again, no true there's the magic bullet to it. But it is something we are tracking to see if we can uncover something else. We're using the interest rate as a proxy to macroeconomic conditions. So, the data science folks are sitting there thinking about, well, okay, is there some other, macroeconomic input we could use to even better fine tune the model?
That's great. Thank you. So one of the questions from the audience, and I'll riff a little bit on it, it's around Canadian house prices compared to the US market. I know you've got experience cross-border. Just broadly speaking, maybe either current or more from a historical perspective, what have you noticed that would be interesting to the group?
Well, one of the things I was told when I was a youngster, one of the biggest differences between the American market and the Canadian market is Canadians will always pay their mortgage. They will stop paying for their car, their Rogers cable, all that good stuff, but they really do need to keep their home. And oddly enough, in the United States, the most important payment that American consumers tend to make is for their automobile, which I found was interesting because I guess you can sleep in your car if it's big enough and you need to. But I think the markets behave so much, they're different but the same. Granted, the US is, 10 times larger than we are. And they also have different lending rules and different kinds of mortgages. You can lock in for 30 years at a really low interest rate, and you never have to refinance. You don't have to do anything. So I think the American market's going to be a lot quieter as sort of the economies get back in step, the supply chain problems, geopolitical stuff settles out. I don't think they're going to come back necessarily as fast as we will, because the conditions down there are just that much different.
Yeah. This one's, I think, so one is someone saying that they missed maybe a bit of the beginning of the presentation or the opening comments, but they're wondering about our research or our opinions showing the media missing the headlines.
Oh, well, yeah. So again, I think, as you pointed out, Yvonne, we're certainly not trying to beat up the media. I'm an avid consumer of the Globe and Mail and the Financial Post. But again, I think part of the issue for the media is they don't have access to everything that you and I have access to. Certainly, our house price index customers have access to. So So they do, they do sort of glam on to, what makes a headline. Um, and, do they have the same ability as we do to get really down into the nitty gritty to do some, investigative journalism? I think if they had the ability to, they would, because I think, journalism in Canada is fantastic. Um, so, again, I think it's a matter of, you know, believe, I can't remember what that quote is from. I can't even remember what it is, but trust but verify, right? So believe what you see, but dig a little deeper to understand what are the mechanics of what's actually happening. Don't just don't just assume because they say it's gone down 20%, it's gone down 20% everywhere. Like, let's face it, I know my neighborhood inside and out because I walk around it all the time. There's nothing for sale. So, if the value of, the reason prices go up and down is because of those transactions. And if there aren't that many transactions, you really have to take some things with a grain of salt.
And I'd say in general too that the nuances matter, and you pointed
Mm.
that out. Is it the average home in a neighborhood? Is it, is that changing? Is that part of why the prices are going down? And it's not necessarily that a specific home on that street has dramatically decreased. So the nuances around what you're measuring, how you're comparing, either different property styles, neighborhoods, even different indexes, all of that matters. And sometimes the devil is in the detail. And it's not to say maybe directionally that certain things are correct or incorrect, but the extent of it might be.
Yeah. Yeah.
I'm just going through some other ones. One one is asking about, and I know it's not necessarily within the topic here, but asking about energy bills and if the appraisal industries have found ways to value a home around improvements around energy. And I know we've done some research in terms of, I know the government's been coming out with a lot more rebates and other things like that. Uh, you've probably spent a lot of time thinking about this. What are your thoughts?
Um, well, it is interesting. I do have a recreational property that's completely off the grid. So it runs on solar panels, and batteries and all that good stuff, and wood stoves. That's how we stay warm.
Yeah, garbage warrior of you. It's awesome. I
Uh,
didn't know that.
yeah. So it's interesting because I think the programs the government has in place, I think they're certainly valuable. I think they're really sort of hard to get through. My house needs new windows. I need to do an energy audit beforehand. I need to spend the money on the windows. I need to do the energy audit after the fact. And I think there's opportunities to sort of streamline some of this stuff. I mean, if you think about, I have a hydro bill and I have a gas bill. And there are ways to mathematically convert my consumption into kilojoules of energy or gigajoules, whatever the metric is. And that, I should be able to compare that to a best built, most efficient home in, my part of the country. Because obviously my house isn't going to use as much energy as somebody's home in Yellowknife. So, but if we could do something there, that folks could almost enter, 12 months of utility bill usage. The government could sort of spin up some kind of a number, like an enter guide number. Oh, you're a 150, and then I do, put new windows in, and uh, they'd obviously have to account for climate differences and things, like if it's a hotter summer or a colder winter. But I think there's math there that we could apply to understand that after 12 months, oh, he did spend the money on the windows, and look, he's now a 135. Great. We'll give Rob a little bit of a payback for doing his investment, trying to keep the planet from, disintegrating, and, helping out across the board. And, are there programs that, the lenders could get behind when it comes to this kind of stuff? Um, you know, if I could prove to a lender that my house was best of breed when it came to energy efficiency, is there something the lender could do for me on a rate break, things like that? Because we all do want to do better for the environment, and I think there are opportunities, maybe not galore, but I think there's a lot of opportunities to do a lot better than we're doing it now. Maybe.
Yeah, and I think as Rachel Maddow would say, is watch this space. I think there's a lot of opportunities for information to be captured, to be valued into homes, to be able to be shared, and to really benefit consumers and really stakeholders broadly in our planet at the same time. There's a question here around the federal foreign purchaser ban, if you think that could have a material impact on the CMAs that we track. I'll just take a personal, or I'll tell a personal story. So I know someone who is in Vancouver and had been looking at places, and a foreign buyer had actually put the home on for sale because they knew that the taxes were going to be more onerous than what they could sell it at now. So it could, I know it is a little bit more marginal in terms of, does it have a huge impact on supply or even behavior, but wondering what your thoughts are.
Yeah. Again, how many foreign buyers are there actively in the market? How many have actually purchased in the last however many years? It's a matter of the scale of the problem, and I think definitely if you go down to the neighborhood level, there are certainly areas of the country where that activity is far more prevalent than others, and it's having a negative impact on the locals, so to speak. So again, it's not. Just going to admit defeat on this one, Yvonne. I don't really have an opinion, but if I was going to start thinking about it, I'd want to know the magnitude of the problem first. And I really don't have a fantastic sense of in a particular part of the world, how much of an impact is that having on the markets?
Yeah, we can look into it in maybe one of the next
Yeah.
webinars. So you can do that. That sounds good. I'll do two more questions maybe. So one question around Bill 23, the More Homes Built Faster Act. If you think that that's going to have any impact. Yeah.
Yeah. Okay. Let's build more
On
homes
house
faster.
prices specific. Yeah.
Yeah. I think it's a great idea. I think certainly there is an awful lot of, I hate to use the term red tape, but let's face it, we don't want to build bad homes quickly. We want to build good homes quickly, and municipalities, provincial governments, they'll have a role to play in, trying to speed up the ability to get more homes built. Um, my only concern with it, I think it's a great idea. My only concern is what kinds of homes are we going to build? Where is the demand? And again, from a personal perspective, I got 4 kids, and my daughter doesn't believe she's 25. She doesn't believe she'll be owning a home until she's 40, because they just don't seem to be building first-time home buyer type homes. Nice big single-family detached, 2-car garage, yada yada. So the kind of house that she's looking for to start a family, that's sort of in the townhouse kind of thing. I understand developers have to make money. Lot sizes are small to maximize the number of units that they can build so that they can realize a profit on their investment in a huge bunch of acreage. I totally get it. Lived that life for 10 years as a surveyor. So, but I think the proof's going to be in the pudding. Can the municipalities, can the provincial government figure out a way to speed up the approvals process? Our developers, are a lot of talk lately about condo projects that are stalled because nobody wants to spend the money to build because it's the wrong time. I don't think we should be building homes in green spaces or in the green belt. And land is finite. So let's build things that are on existing transit lines. I think something else that would go a long way to helping things out is let's improve transit. If we can get people to jobs in less than 2 hours, the GO trains, the TTC, all the transit systems in the major centers where the jobs are, if we got to invest in that too. Our infrastructure is basically 30 years behind where it needs to be. A lot of problems to solve. They all take money. We all need to, think about how our tax dollars are being spent. But I think more homes faster, absolutely fantastic idea if they can pull it off.
Yeah, and I think key is if it's the right homes too. So it might not be that townhouse, but you think of major cities in Europe and North America, like New York, where you have, let's say, a 3-bedroom apartment and you can have a family or 4. So
Yeah.
I agree. We've we've gone through as many questions I think that we can, being respectful of everybody's time. Want to do a bit of a wrap up. So we hope that been you've been given some interesting, helpful, and unique perspectives on the housing market and house prices, and some thoughts on what's going on in the market and under the headlines. As noted before, soon after the webinar, we'll send you an email with the webinar recording and a presentation deck. And if you want to be kept up to date on upcoming webinars, click on the subscribe button in that email. So for example, we're going to be having a market rent AVM panel on February 22nd. And immediately after you log out, you'll get a quick survey. So if you want to give us feedback, we'd love that in terms of what you liked about the webinar, what we can improve upon, topics of interest. We'd love hearing your feedback. That's great. And if you have any questions or anything else, please feel free to reach out to the RPS team if there's any questions you have or that we can do to help you. And so with that, a big thank you to Rob Maughan for sharing information and all this information and his insights. And of course, a big thank you to you, our audience, for joining us today and participating in this session. We hope that you, your families, and colleagues stay happy, warm, and safe. And again, a big thank you.
Thanks, everyone.